Taxes can feel confusing and intimidating, especially when you're newly self-employed. But ignoring them will only lead to more stress, bigger bills, and that dreaded sinking feeling come tax season. That's why step 2 of the 8 essential steps to set your business finances up for success is all about learning how income taxes actually work, in simple terms. Hi. My name is Kat and I'm a chartered professional accountant, on a mission to empower self-employed Canadians to manage their business finances with ease, clarity, and without the high cost of traditional accounting services. If you're watching this as part of step 2, welcome back. And if you're wondering what in the world I'm talking about, you can grab the free guide below. It walks you through 8 essential steps to get your business finances set up the right way. Today's video is all about how income taxes work when you're self-employed in Canada. We'll go over what it means to be self-employed for tax purposes, how income taxes work in Canada and how that applies to your business, why you'll likely owe money at tax time, and what to do if you can't pay. At the end of the video, I'll share 3 tips to help you reduce your tax bill and avoid scrambling when tax season rolls around. So let's jump right in. First of all, what does it mean to be self-employed for tax purposes? In Canada, being self-employed usually means you're a sole proprietor, an unincorporated business owned by one person. This is different from a corporation, which is a separate legal entity from you, the owner. As a sole proprietor, your business income goes directly on your personal tax return, along with any other income you've earned, like a salary from a job or investment income. To report your business income and expenses, you fill out Form T2125, Statement of Business or Professional Activities. Your tax filing deadline is June 15th, but your payment deadline is April 30th. In other words, if you wait until June to file and it turns out you owe taxes, you'll be charged interest going back to May 1st. Next, let's go over how income taxes work in Canada and how that applies to your business. First, it's important to note here that income taxes and sales taxes are 2 different things. Income taxes are what we're discussing today. Sales taxes, also known as GST/HST, are a whole other topic which I'll cover in future videos. Alright, so let's dive in. Canada uses a progressive tax system with multiple tax brackets. This means that each portion of your income is taxed at a different rate. For example, in 2025, you'll be taxed 15% on income you earn up to about $57,000, 20.5% on income between $57,000 and $114,000, and so on. This is federal taxes only. Each province also has its own tax brackets and rates, so the total amount of tax you'll owe depends on where you live. So how does this apply to your business? As a sole proprietor, you're taxed on your net business income. That's your revenue minus any eligible business expenses. For example, if your business brings in $30,000 and you have $10,000 in expenses, you'll be taxed on $20,000 of profit. This amount falls in the first tax bracket at 15%. Now let's say you also earn $50,000 from a job. That $20,000 of business profit will be added to your salary and you'll be taxed on $70,000 total income. So about $57,000 will be taxed at 15% and the rest at 20.5%, the rate for the second tax bracket. This is why it's so important to claim every legitimate business expense. Every dollar you deduct reduces your taxable income and therefore your taxes. We'll go into more detail at the end of the video and in future videos as well. Another thing to factor in is CPP, Canada Pension Plan contributions. When you're self-employed, you pay both the employee and employer portion of CPP. In 2025, that's 11.9% on earnings over the basic exemption amount, up to the maximum annual pensionable earnings. Without going into too much detail, what you need to know is that this can add around $8,000 to your tax bill if your income is high enough. Now that we understand the basics of how income taxes work when you're self-employed in Canada, let's talk about why you'll probably owe money at tax time. Before we go on, if you've learned something so far, please take a second to give this video a like, it really helps the channel. Alright, so as we just mentioned, CPP alone can add a significant amount to your tax bill. On top of that, no one is withholding income taxes from your paychecks as a sole proprietor, unlike when you're an employee. Clients pay you the full amount, and it lands in your bank account. So when tax season rolls around, you'll fill out your return and find out how much you owe. If you haven't paid anything to the government throughout the year, you'll end up with a balance owing that can come as a bit of a shock. Let's go over a detailed example so you can see how this works. Let's say you live in Ontario and made $40,000 from your business this year. You also spent $10,000 on eligible expenses, so you're being taxed on $30,000 of self-employment income. If we plug that number into a free online tax calculator, we can see that you'll owe over $5,800 in taxes, including over $3,000 in CPP contributions alone. And if you're not prepared, you might find yourself in a situation where you can't afford to pay. Ideally, you want to avoid this by planning ahead. But if it happens, don't panic. You do have the option of contacting the CRA to request a payment arrangement. It's better to work with them than to ignore your bill and hope it goes away, which will just make things worse. So this being said, how do you avoid the stress and scrambling that comes with tax season? Let's dive into 3 practical tips. First, track your income and expenses throughout the year. This gives you a running estimate of your net income, so the amount you'll be taxed on doesn't come as a surprise next April. It'll also make claiming business expenses a lot easier. Expenses which are not tracked typically don't get claimed, which results in paying more taxes than you need to. And since you're taxed on your profit, every dollar you write off helps reduce your taxes. Also, you don't need fancy or expensive software to do this, a simple spreadsheet works just fine. Setting aside some time each week to log all of your transactions will save you a headache when tax season gets here, and will help ensure you don't miss any eligible business deductions. Second, save for taxes throughout the year. Every time a client pays you, set a certain percentage aside and don't touch it. This'll help you build a cash buffer from which to pay your taxes. A good rule of thumb is to put 25 to 30% of your business income aside in a separate savings account. Third, file and pay your taxes on time. Interest and penalties are charged as a percentage of what you owe, so the bigger the balance, the bigger the cost. You don't want to unnecessarily increase your tax bill by being late. Ideally, you'll want to file and pay by April 30th, even if the filing deadline is June 15th. Alright, let's wrap this up. Here are 3 key takeaways from this video. 1. As a sole proprietor, you're taxed on your profit, revenue minus expenses. 2. You'll likely owe money at tax time, so be prepared by planning ahead. 3. Reduce last-minute stress by tracking your income and expenses, setting money aside for taxes throughout the year, and filing on time. That's all for today's video. I hope you found the information helpful. Don't hesitate to ask your questions or submit special requests for future videos in the comments. Be sure to hit that notification bell if you want to be the first to know when a new video is released. Thanks for tuning in, and I'll see you next time.